Hello, and welcome back to the channel. I'm Algabot, and today we're taking an educational look at a MetaTrader 5 expert advisor called Straddle Hedge. This is a pure price action approach. It uses no indicators at all, no moving averages, no oscillators, no patterns. Instead, it watches the raw highs and lows around a quiet trading range, and it places orders on both sides of that range at the same time. Over the next few minutes, we'll explore how it measures a range, how it manages two opposing orders, and how it responds to both real and false breakouts. Let's get started. So what exactly is Straddle Hedge, and what makes it different? At its heart, this is a breakout strategy with a built-in fallback plan. Markets spend a great deal of time moving sideways, coiling into quiet ranges before they eventually push out of them. When that push comes, it can be a genuine breakout that keeps running, or it can be a false breakout that pokes just beyond the boundary and then snaps right back. A simple breakout system tends to win on the first kind and struggle on the second because it gets stopped out, re-enters, and gets stopped out again on the reverse move. That repeated back and forth is often called a whipsaw. Straddle Hedge tries to address that problem directly. Rather than committing to a single direction, it brackets the range with two resting orders at once, one above and one below. This is the straddle. When price breaks one side, the order on the opposite side is deliberately left in place to act as a hedge. If the breakout is real, the running order works toward its target and the unused order is canceled. If the breakout is false and price reverses, that second order activates, and the strategy then holds positions on both sides at the same time. Because it relies only on raw price, the highest high and the lowest low over a defined look back, there are no indicators involved whatsoever. This makes it a price action system in the truest sense. It is typically discussed in the context of liquid, range-prone foreign exchange pairs, such as the euro against the dollar, on intraday timeframes like 15 or 30 minutes, where false breakout whipsaws are common. As always, this is educational information only, and trading carries real risk, including the risk of loss. Let's walk through the mechanics step by step. The strategy runs as a simple state machine with three phases: idle, armed, and engaged. In the idle phase, the account is flat and nothing is resting on the chart. The strategy measures a range over the last group of closed bars, by default 20 of them, set by the RangeLookback parameter. The highest high of those bars becomes the range top, and the lowest low becomes the range bottom. The distance between them is the range width, and almost everything else is scaled from that single number. It then straddles the range. A buy stop order is placed above the range top, and a sell stop order is placed below the range bottom. The offset beyond each boundary is controlled by the buffer fraction parameter, a small fraction of the range width. Once both orders are resting, the strategy moves into the armed phase. In the armed phase, it simply waits. If neither side triggers within the number of bars set by expiry bars, 8 by default, both orders are canceled and a fresh range is measured. There is also a spread filter. If the spread is wider than the max spread point setting, the strategy holds off placing new orders. When price finally breaks one boundary, that order fills and the strategy becomes engaged. Here is the key design choice. The opposite order is not canceled. It stays on the chart as a hedge. Each filled leg carries its own protective stop loss and its own take profit, both measured as multiples of the range width. The take profit distance is set by the reward ratio, 2 widths by default, and the stop loss by the stop multiplier, 3 widths by default. The stop is intentionally wider than the opposite boundary, so that if price reverses, the hedge order fills before the first leg is stopped out. Sitting above all of this is a basket money management layer that runs on every tick. It adds up the floating profit and loss of every open leg together. If that combined figure reaches the basket take profit amount, everything is closed and the cycle restarts. If the combined floating loss reaches the basket stop loss amount, the whole book is flattened. That basket stop is the firm's ceiling on risk, and a strong one-way trend after a hedge has formed is the scenario it is designed to contain. Let's look at the actual MetaTrader 5 code driving this. At the top are the input parameters, and these mirror the strategy's settings exactly. RangeLookback sets how many closed bars define the range. Buffer fraction is the offset beyond each boundary. Reward ratio and stop multiplier scale the take profit and stop loss from the range width. BasketTpMoney and BasketSlMoney control the account currency exits for the whole basket. Expiry bars ages out an untriggered straddle. Max spread points filters wide spreads. Lot sets the volume per leg, and magic tags the orders. Below that, the strategy has already measured the range. The width is simply the high minus the low. The buffer is the larger of the buffer fraction times the width, or the broker's minimum stop distance. The buy price sits one buffer above the range high, and the sell price sits one buffer below the range low. Now look at the two signal blocks, because both sides matter equally. In the long block, if the buy price sits a valid distance above the current ask, the strategy calculates a take profit above and a stop loss below, then calls trade.bystop to place the order. The short block is the mirror image. If the sell price sits a valid distance below the current bid, it calculates a take profit below and a stop loss above, then calls trade.sellStop. Notice the symmetry. The long leg targets a move upward, the short leg targets a move downward, and each carries its own protective stop. Together, these two resting orders form the straddle that wraps the range. Now let's bring it all together on the chart and follow two complete trades, first a long, then a short. Watch the two blue lines. The upper one marks the range high, and the lower one marks the range low. On the left, price is quiet. Across these first several candles, the market drifts back and forth between the range high near 1.0869 and the range low near 1.0834. Notice how each push toward the top is sold back down, and each dip toward the bottom is bought back up. This is exactly the kind of consolidation the strategy is built to wrap. With the account flat, it measures this range and places its straddle, a buy stop just above the upper line and a sell stop just below the lower line. Watch the sixth candle. Price finally pushes with conviction and trades up through the upper boundary. That triggers the buy stop, and our long position opens at around 1.0874, just above the range. The opposite sell stop is left resting below as the hedge, in case this move turns out to be false. This time, the breakout is genuine. The next candle extends higher, closing near 1.0900. Buyers stay in control, and the candle after that pushes up to around 1.0919. That reaches the long leg's take profit, set a defined multiple of the range width above the entry, and the position closes. Because no reversal occurred, the resting hedge order was never needed, and it is canceled. Now watch how the strategy resets. With the account flat again, it measures a new, tighter range up here. The upper line steps up to about 1.0919, and the lower line to about 1.0890. Price drifts sideways for a couple of candles, coiling once more. The strategy straddles this fresh range with a new pair of orders, a buy stop above and a sell stop below. This time, the resolution comes to the downside. Look at the candle that breaks beneath the lower line. Price trades down through 1.0890 and triggers the sell stop. Our short position opens at around 1.0884. Again, the opposite order, the buy stop above, is left in place as the hedge. Sellers follow through. The next candle drops toward 1.0862, and the final candle extends down to about 1.0844. That reaches the short leg's take profit, a set multiple of the range width below the entry, and the position is closed. So across this sequence, you have seen both halves of the system working symmetrically. The straddle brackets a quiet range on both sides. Whichever side breaks first becomes the active trade, and the other side stays on the chart as a hedge. When a breakout runs cleanly, like both of these did, the per leg take profit banks the move and the unused order is pulled. But it is just as important to understand the case the chart does not show. If that sixth candle had poked above the range and then immediately reversed back down through the bottom, the resting hedge would have filled too, leaving a long and a short open at the same time. In that locked situation, the basket money layer takes over. It watches the combined floating profit and loss of both legs, and it closes the whole basket the moment the net turns sufficiently positive, or flattens everything if the combined loss reaches the basket stop. That is how the design aims to turn a typical whipsaw into a scratch or a small recovery rather than a double loss. Keep in mind that this is a clean, illustrative example. Real markets are noisier, breakouts fail more often than a single chart can show, and a strong one-way trend after a hedge has formed is the scenario where this approach can still take a loss. The chart shows the logic, not a typical outcome. And that brings us to the end of our look at range straddle hedge. We covered how it measures a range from raw highs and lows, how it brackets that range with a pair of stop orders, how it keeps the opposite order alive as a hedge when one side fills, and how the per leg targets and the BasketMoney layer manage the exits. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries risk, and losses are a normal part of trading. If you found this breakdown helpful, please like the video, leave a comment with the strategy you would like us to analyze next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.